Okay, so what I wanted to do is I wanted to take a couple minutes and talk a little bit more about what trading is and all this. My thought is I tell a lot of people um, I think financial advisors are a waste of money for most people. You could probably make a lot more money than on your own. You don't need that much time. You don't have to day trade and do like what I do. Not necessary, but learning a little bit of information can save you a lot of money. Um, Financial advisors, no offense to them, but a lot of them make money either way, whether they lose money or make money. Hedge fund managers are different. Most people can't invest in hedge funds because they don't have the money. But guys, people who work for like Edward Jones and those kind of places, a lot of times it doesn't really matter. You give them your money. If they lose 10%, it doesn't matter. They still make money. Sure, sometimes they make less because they make a percentage of the money that you have, but they still make money either way. Whereas there's some studies out there, and you can Google it. It's pretty simple. That the average mutual fund manager or financial advisor cannot even beat the regular S&P 500. What that means is, if you were to put your money on January 1st of any year, you just buy into the S&P 500, maybe a ETF or some mutual fund that just tracks all of those stocks, and you just walked away. At the end of the year, you would have done better than most mutual fund managers. They can't even beat that average. That tells me that most people can do it themselves. So I don't have any financial advisors because I do it myself. But there's a lot of things you can do on your own that will save you a lot of money. Now, the thing that you're looking at here, this is just one way. This is day trading. This is the E-mini S&P 500 futures contract. Now, the only difference between what Warren Buffett does, he's an investor, and what this is time. That's the only difference. I might hold a trade for 30 seconds. Warren Buffett holds it for 30 years. The principles are still exactly the same. He doesn't really short the market, though, which I believe. So basically, what he's trying to do is buy here and sell up here. That's all he's trying to do. He hopes to buy when it's low and sell when it's high. I do the same exact thing, except instead of waiting for it to go all the way maybe up here, I will buy it here and sell it here. Or buy it here and sell it here. And that's it. So the only difference between what a day trader does and what Warren Buffett and those kind of people do is just time. That is it. Everyone's a speculator. The only difference is time. Now, futures contracts are a little bit more complicated. I don't know, many people have probably seen that movie Trading Places, or you've heard of commodities, oil, pork bellies, orange juice, gold, silver, wheat, corn. All of these things trade exactly the same way as this right here. The only difference is when this contract expires in June, these contracts are settled as a cash value. The S&P, obviously, you cannot deliver. If I am holding a contract to buy the S&P 500 in June, nobody's going to drive to my house and deliver me the S&P 500. No. These futures contracts are cash settled. So I either have to pay if I'm holding it, or somebody pays me if I'm holding it, depending on what the price is. Now, futures contracts for wheat, corn, oil, and those kind of commodities, those are settled in real items. So if you happen to own a futures contract that says you're going to take possession of 10,000 barrels of oil, you better figure out what you're going to do before that contract expires, or somebody will actually show up to your house with 10,000 barrels of oil and give it to you. Now, most of the time that doesn't happen. Brokers call you, they warn you, hey, rollover's coming, the contract's going to expire, do you want to roll it into the next month, and blah, blah, blah. But the same thing happens to wheat, corn, and all that. So a futures contract, what it is It's the obligation to either buy or sell a certain thing at a certain date. They were originally designed for farmers and such who wanted to lock in prices of agricultural items. Some of you may have heard the story of Southwest Airlines. The reason why they were able to be so profitable is because they bought gasoline futures long time ago. They locked in their price. I don't remember what it was, but let's just say the price was $2 a gallon. They locked in that price. So what that means is if the price rises, they have a contract that says even if regular gasoline is $4 a gallon, they still only get to pay $2 because they have a contract that says it. That's why a lot of other airlines, they didn't do that, and therefore they lost a lot of money. So that's what Southwest did. They bought futures contracts, locking in the price of gasoline. A lot of businesses use those for a longer period of time. They go years out. Whereas myself, I'm looking at futures contracts just for the next rollover month, which in this case is June. The March one just expired a few weeks ago. Now we're into June. So this contract right here will trade until sometime in June, first or second week in June. But there's a lot of warnings that say, hey, after that, you better roll into the next month. So that's what a futures contract is. But trading is nothing more than like eBay. This is the price. This is like the eBay guy right here. He's got an item to sell at $1539.75. Well, here's the bidding is going on this side. This guy says, well, I'll buy your item, but I'm only willing to pay $1539.50. I'm not paying $39.75. And then these people up here are saying, well, I'm not selling for $75. I'll sell for, $40 even, or $25, or $40 and a quarter, or $40 half. Same thing with these guys down here. They're saying, well, screw this guy. I want to pay even less than that. So that's what this is. The market is nothing more than a giant auction. That's all it is. Buyers and sellers coming together. That is all that the market is. When a price is agreed upon, a trade is made. Now these are what they call the limit orders, meaning that this could be, right now it says, and these are ticking by fast. I'm going to explain this in another video, what this actually means. But I just wanted to give you an overview of what trading actually is. It's just nothing more than eBay. It's an auction of buying and selling. Somebody wants to sell something, somebody wants to buy something. That's all it is. And the difference between traders and investors is just time. The concepts are exactly the same. Buying at one price, selling at another. A lot of times it's called the fool's theory. You're a fool. You buy it at, let's say, 40 even. You want to sell it to another fool at 41 even and take the profit. It's a fool's game. The only question is who's going to be the fool that holds it at 46 at the top. Somebody's got to buy it up here. So I will talk about how the actual market works as far as how these numbers interact in the next video. That's it. Thanks.